All right. Thank you, David. Great to be here again. And I enjoyed checking into Tim's presentation just before me. But we do have a lot of material to get through. So why don't we jump right in? We're going to talk about how we can auto trade or use algorithms to automate our trading with stock index futures options. And we're going to talk a little bit about gold toward the end of there. So I thought I'd throw that in as a bonus. It's been making lots of headlines lately, but we use proprietary algorithms to basically create these trades for us and then to manage those trades with automated profit and risk controls. So you don't have to screen watch with the way we do things. And we also have a really unique trade alert functionality as part of what we're going to talk about. When you receive a trade alert, you just simply touch accept um, and the order is placed for you. So with that said, remember we are speculating and we always accept risk when you try to make money. If there wasn't risk, there'd be no profit. So do take a look at the risk disclosure. There's a lot there to read, so I recommend taking a screen capture of that with your device. I'll just pause it there for a brief moment. But basically, keep in mind that you should be using risk capital when trading, and there's no basically guarantee of results based on any past performance. So I'm sure you've heard that before. So a little bit about AltaVest. Since 1997, we've been doing this. We are a registered introducing brokerage firm. So almost 30 years now. Time is flying. We've traded millions and millions and millions of contracts along the way, and that is yours truly there on the trading floor at the S&P 500 options trading pit with some of our floor brokers that would fill all of our orders for us. It's my trading partner, Mike there, and another operations director there, Charles. So we've been doing this a long time. We created the Dragonfly option strategy, also a proprietary order execution technology. And then again, clients have been trading with us using millions of contracts with our solutions and trading with our solutions, I should say. We're registered with the CFTC, a member of the NFA, and we're located in California. There's a picture I took visiting the trading floor not too many years ago in New York, and doesn't look like that anymore. A little bit about what we'll talk about actually is the automation that sort of took over. And briefly, just a bit about myself. My name is Eric Gebhard. Been doing this since 1991, registered with my Series 3 license, co-founder of AltaVest, graduated from the University of Southern California with my degree in business. I used to hold various securities licenses. I was in the mutual fund industry for a while with insurance and annuities as well, but I currently have my Series 3 commodity futures license as well as a Series 65, and that's for investment advisors. Okay, with the introductions out of the way, let's get into the heart of the presentation. Then we're going to do a live demo of the software solution we talked about. But first of all, did you know that JP Morgan estimates 90% of US equity trading volume is systematic or algo driven or machine driven or HFT, high frequency trading? You name it, basically it is algo driven. It's not volume such as what we might think, where there's people sitting behind a screen. So much of it is automated. So this is our competition: automation, built-in controls, no emotion. So how can we use algos to trade options in a professional style? So we're going to talk about how we can do that. So the answer is yes, we can do that. So we're going to look at trading options like a large institution or manager, money manager might do it, or hedge fund. So for an example, how do insurance companies exist? What's their business model? Well, maybe we can apply their model to how we trade options. So they're getting paid premium to assume risk, to sell and manage time. They insure themselves by hedging. They're consistent in their approach and they're patient in their process. And they simply do a lot of number crunching. Look at probabilities, favorable long-term probabilities and odds. That's what they're looking for. And again, statistics, probabilities, things like actuarial tables and whatnot. And that's how they come up with their models. And they're looking for the odds to be ever in their favor. So maybe we should do the same thing and have that same attitude and try to collect premium, just like an insurance company collects premium from us. So we're going to look at some premium collection option strategies. We're going to need to manage risk and reward. Never want to get too greedy, of course, or have too much risk. And you'll need some experience along the way, someone to coach you. You'll need the proper tools and the automation. And we're going to look for trades that are what we consider base hits and not necessarily grand slams. Those have a much lower probability of actually coming to fruition, as I think we all understand that. So these are short option strategies. They can be non-directional, they can be bullish or bearish. And again, these short option strategies are collecting premium for the most part. And you look at outcomes that are targeted with a fixed profit and fixed risk in advance. So before we jump in, we're going to look at a couple of the Greek letters in the Greek alphabet and see how they apply to trading. So the first would be looking at probabilities when it comes to options. We'll look at delta. So that is how much does the option value change with a change in the underlying asset price or the underlying ticker price. So it's also the approximate probability of expiring in the money. So that's how option traders perceive and view delta. And that's how we're going to look at it as well. And here's an example. If the delta is 0.25, that means there's a 25% chance that expires in the money, and then a 75% chance, conversely, that it would expire worthless, that particular option. So remember, the delta is never static. It's always moving as price and time of the underlying asset moves as well. And this is important too. It is not the probability of a winning trade. So don't look at delta in that regard or with those from that perspective, I guess you could say. Now, theta is the other letter, the other Greek letter, and that references time when you're speaking of options. So sensitivity to time, and more specifically, time decay. So an option is a wasting or a decaying asset with limited lifespan. So as you know, every option has an expiration date. But theta is a negative number, and it equals 1 day of time decay. And we'll look just a simple example here. If an option premium is 10 points, and then theta is negative 0.05, that means the next day the premium on that option drops to 9.95, and the next day after that 9.90, and so on and so forth, just based on the time decay component of the option value. So here's just a simple graph as to what that kind of looks like. You see the percent of the premium remaining here on the scale, and it drops and drops and drops as you approach time zero. And that's just typical. Every option does eventually expire. So theta decay always increases, and the rate of theta decay tends to increase as you get closer to expiration. I guess you could call the rate of change in theta. So Wall Street pros, they trade multi-leg option spreads to collect premium. So they're not typically selling naked options. They're using spreads. So we're going to look at an example on the E-mini S&P 500 calls. And the presenter, Tim, before me, trades E-mini. So we do a lot of that, a lot about what we talk about here today, with good reason. That's where all the volume and liquidity is, and we'll talk about some of the details on that. But here's an example where you sell a call spread. So this is for a bearish or moderately bullish or non-directional outlook. And here's what it might look like. You can see the market, in this case, the S&P 500 mini, moving around here. And here's the call spread. The red line is the call that you sell, and you collect 4.5 points for selling that call. And the blue line there is the call that you buy as part of that spread, but you pay 2.25 points for buying that spread. And the net result is you collect 2.25 points, $112.50 in this case, minus your commissions. And that's just an example of a call spread. And this trade would work out well, clearly if in this example here, but if you stay well below this red line here, and then you'd be able to uh, basically keep all or most of that premium. And I'll show you how we do that. Here's an example of a put spread. It's really just the inverse. This is when you might be bullish or moderately bearish or non-directional. And again, you're selling this out of the money put spread. The red line here is the put that you're selling. You collect 3 points. The blue line is the put that you're buying. You pay 1 point. The net result, you collect $100 minus your commissions, of course. And then if the market stays above that red line or well above it, then this trade would do well. You can see the expiration date here at the end of the trade. And we're going to show you some examples of how to do this. Here's an iron condor, and it sounds like a crazy name, but it's really just a combination of the put spread and the call spread that we just reviewed. And it's a non-directional strategy. And this is really a simultaneous position where you place the call spread and the put spread as one order. You don't want to leg in one side at a time. At least we don't suggest you do. That's not the way we do it. But you're selling this out of the money call spread and out of the money put spread simultaneously. So you can see the numbers here. We don't need to get into all the examples of the details here, but the idea is you collect a net premium from selling the out of the money call spread and out of the money put spread. And this is an example of what might happen here. You see the market trading back and forth. It goes down a lot, it rallies and recovers a lot. And the idea then is to cover that particular position and close it out after theta decay works its magic. So that's what this might look like. So you can see in this example, this blue arrow here is where you buy the spread back. So you've sold the spread, you've collected premium, and then you buy it back right here in this example because you have a signal here. We're going to show you what these colors mean, but this is the signal to close out that position, in this case with 19 days till expiration. So you can see it expires here, but you don't hold on to the position all the way through expiration. So you sell the spread, and then you intend to buy it back for less than what you initially received for it. And then here's a dragonfly. This is our proprietary strategy, the dragonfly. And it's really just a variation on the iron condor strategy. Again, it's a premium collection approach. And this is what it looks like. It looks a little busy, maybe a little complicated at the moment, but it's really not that difficult. You can see you sell these 4 out of the money calls here. You buy 3 further out of the money calls and then 1 closer to the money call. And then for the puts, you have the same structure on the puts. You sell these 4 out of the money puts. You buy 3 further out of the money puts and then 1 closer to the money put as well. And you'll notice this put that you buy, I'm sorry, this call that you buy here is 50 points closer to the money compared to the 4 that you sell, but it doesn't always have to be. That's just this example. But this call you buy and this put you buy completely changes the dynamic of these trades compared to, say, an iron condor structure. Because remember, you own this call. For example, if the market were to start moving higher and higher and higher, this call will have a higher delta and it will gain in value more rapidly than the out of the money calls that you have sold. So we will look at what happens here to that example after theta decay or some time ticks away. So you can see here, the E-mini S&P traded along, and right here, this blue arrow, you get a signal right here to close out that position and to buy it back. So again, just like a condor or a regular put spread or call spread, you sell it, collect the premium, and then you hope to buy it back later for less than what you received for it initially. So sell high and buy low. That's the idea here. And be sure to stick around in just a few minutes. I'm going to jump into the demo, but we're going to show you a live trade alert, how that works, where you just simply touch accept, and you'll accept those alerts here. I'll show you how to do that. So that'll be just a few minutes. But here's the question: how do you actually create a spread? Because I guess I understand it could be a little bit overwhelming. You have all the option chains to look at. You have all the expirations, all the strike prices, which strategy to apply. at what price? In other words, what's your entry timing? And then how do you even manage that position? So that is what we're going to talk about in the demo called ThetaTrader. That's our proprietary technology solution that we developed. And these are pre-built option spreads. And these are built by a proprietary algorithm. These are called theta trades. They're one-touch. They include one-touch responsive trade alerts, I should say. And you can have strategies for bull, bear, and flat market conditions, automated risk and profit tracking, something called the risk thermal indicator, or the RTI. It's a good picture down on the trading floor with some of our floor traders down there a few years back. So with that said, we're going to jump into the demo. And let me switch screens so we can take a look at ThetaTrader. Okay, looks to me like, oops, just a second here, folks. I want to make sure you're looking at my screen. Ah, there we go. Okay, I just lost a little toolbar, but if you can't see the screen, let me know, but I think you can. So this is our ThetaTrader dashboard. And you'll notice here you have an active trade alert section. We're going to show you how that works in just a minute. Then you have our theta trades here. And then you have our open short positions. Then you have open long or bought positions here. And I'll explain those colors here. And this is just a demo account I use, so don't really pay too much attention to the numbers. But this is what it would look like if you had a real account with us. ThetaTrader then essentially is integrated with your trading account at AltaVest and displays all of your metrics here. You can see your current quotes. So we're going to address this trade alert in just a second, but for now, because we talked about the dragonfly and the condor, I'll show you how that works here. There are bullish strategies that are pre-populated. You can see bearish strategies and of course neutral or non-directional. And you'll notice the markets here. You have the Russell 2000, the NASDAQ 100, and the S&P 500, and these are all the E-mini. And that's the E-mini family of futures contracts and stock indexes that we're talking about. So to start things off, we'll just look at an iron condor. So you can see there are, 6 to choose from, 6 expirations, and the trades are pre-selected for us by the algorithm. And you'll notice if you hover your mouse over, you'll see a pop-up kind of explaining the trade, although I don't know if it shows up on the webinar. But so here's the week 3 January expiration. You can see the puts and the calls here. This is your profit potential maximum at expiration. This is called your targeted annualized return at expiration. And it's really to compare one trade to another. Don't expect that if you place this trade that you're going to have a 222% return on the trade. That just assumes you annualize that. So it's really to compare one trade to another to give you some perspective. But we'll drill down on this one here. Takes a little time here. And this is the January week 3 expiration. So you have this table of all the details on this particular trade. The first thing I like to do is look at a graph. So this gives you an overhead perspective. Here's where the current market is, price. So you're selling this out of the money call spread and this out of the money put spread. The difference between the puts and the calls that you're selling, it's really over 1,000 points. So you can see you have a lot of margin for error there. And you'll notice here the days till expiration, the expiration date, the quote, settlement value, the premium, put risk, call risk, commission, your capital, cash required, your profit potential, targeted return on cash, and then again, that targeted annualized return. And you can see the cash required here on the trade. That's another way to say that's what the margin requirement is to place this trade, but that's the cash required. And we're going to look at this one by one here and notice the put the puts that are being sold, the 5390s, have a delta of 9.79%. So that means you have over a 90% probability that these puts you're selling to someone else will expire out of the money. So that's why the algorithm chose that. And then the call is even better, 6.89% delta. So you're looking at over a 93% probability that these calls that you're selling to someone else will expire out of the money. And then you can see the other put and call here that are being purchased. And if you wanted to change the strikes, you could here, but that sort of defeats the whole idea of placing this type of trade. And it always defaults to a sell when you're selling the iron condor, non-directional strategy, and 1 is the quantity by default. So we'll go ahead and change that just for the sake of this. How about 5? So here you see your cash required goes up, your profit potential goes up, and so on and so forth. So that's how simple it is to sort of look at a theta trade on any given day, and then you want to place that order, and you just do that. And this is a demo account, so it just assumes that your order is filled. So that's how simple that is. Let's look at another trade now. We'll look at a dragonfly. And then we're going to look at something really unique. We have sort of a back testing time machine or trade simulator. Give it just a moment here. Of course, just my luck, it seems to get a little glitchy here sometimes when I'm running a webinar. I don't know why that is. Just give it a second. If not, I can just refresh maybe the page and give that a try. And if this keeps doing this, I'll just jump to another. There we go. I don't know why it did that, but here's a dragonfly. We'll just pick on the one with the most days till expiration. And I'm just randomly picking any particular trade here. So this is a dragonfly on the E-mini S&P 500. This has, let's see here, 72 days till expiration. And here's what this graph looks like on the dragonfly. Remember, you sell 4 calls, buy 3 further out, and 1 closer to the money, and the same structure with the puts. And what's great about this, the beauty is the algorithm has pre-selected and chosen our strikes for us and chosen the value of the trade and so on and so forth. You can notice the cash required is a bit higher than a condor. It's because you're selling in units or increments of 4 puts and 4 calls, not 1 put and 1 call. So if you did 2 dragonflies, this would be 8. And if you did 3, it'd be 12 and so forth. And you can see the cash required 46.19, profit potential 381, targeted return on cash, and your targeted annualized return. And these numbers are always typically going to be lower compared to a dragonfly, compared to a condor. And that's because when you buy this call and you buy this put, it costs you money. So it's like buying additional insurance, and it creates a more risk averse trade, but it costs you money. And so it will reduce your, let's just say, your profit potential compared to a condor. But there are some major benefits though, and I'll show you that in just a second. But again, you can see the strikes here that you're selling on the puts and the calls. You have a 9.94 delta and a 6.34 delta here on the ones you're selling. So again, over 90% and 93% probability that these puts and calls will expire out of the money. And it always defaults to a sell because you're selling the dragonfly. And we'll do 2 of these here. And we'll leave the value here at 9.3. You could change it if you wanted, but we'll go ahead and place that order, and there you go. Just that simple. Now, let me show you a really unique feature. Another unique feature within ThetaTrader is we have a trade simulator. You can access it right here. And I've loaded some trades so we can kind of save some time. And this is really by what I like to call a time machine. So you can see here there's a week 3 November expiration for an iron condor, a trade placed on September 26. It had 51 days till expiration. And we can use these buttons here to go forward or backward in time. And you'll notice day by day here, this is the market price changing. You can see the green RTI, and green means good. It means do nothing. Just let the trade keep going. You can see the trade, the P&L, the profit and loss, a little bit negative at first, and that's normal because theta decay hasn't really had a chance to work yet. And we'll just go ahead and keep playing here. If you want to see the whole screen, there we go. And then it turns blue with 11 days till expiration, and that's your exit signal. Now, this is really important. Whenever it turns blue for a profit, your order can automatically be submitted for you. So again, you don't have to screen watch or watch, uh, get up early or hang around late and monitor and place these orders. ThetaTrader will automatically place these orders for you. And I'll show you how to do that in just a second. But you can see with 11 days till expiration, here's the expiration date here. You had a signal to close that trade out right there. Now we'll jump on a dragonfly. So that was a week 3 November iron condor. Here's a week 3 November dragonfly. We'll use these buttons here again. And you don't have to use these play buttons. If you want to simulate, you can go all the way to the end or backwards or forwards in one click. But just for the demo here, we're doing this. So you can see this trade's working out well. The P&L is working nicely. The theta decay is working. The trade is working out nicely, even though the market's moving higher. It's not moving enough or quickly enough to really make a difference. And there we go. Again, on the dragonfly here, this ends up being a good trade. The blue RTI means get out of the trade. And this, again, can be automated. So that's kind of an idea of how the condor and the dragonfly are designed to work. And we'll look at this one here. Here's another condor. I kind of forget exactly what happens, but I think I put this in here to compare it to a dragon. Let me show you. So it's moving a little bit quickly to this upper boundary. So you can see the trade is turning negative, but still green RTI, do nothing. Then it gets yellow, elevated risk, but still do nothing. And then it turns red. So you take a loss on this trade. You took a loss on this trade, and the red RTI means get out. And again, this can be automated too. So whether it turns blue or red, whichever ever comes first, the order is automatically placed for you. So I wanted to make sure to point out that, not every one of these trades is going to be a winner. We're not trying to cherry pick, but I do want to point out the difference. So this is the Iron Condor for the week 3 July expiration. So here is the week 3, the week 2 July expiration on the Dragonfly. Want to make sure, sorry, yeah, week 2 July, same thing. I want to compare apples to apples. So here's a dragonfly. So basically what I'm saying here is imagine you placed a dragonfly instead of the condor, and that's the same expiration on the same date. So you can see it turns a little bit yellow, just like it did on the condor. And then it turns blue. So you get a profit-taking signal with 15 days till expiration. So you're out of the trade right here, and you're moving on to a different trade. So instead of having a loss on the condor, you can see the dragonfly ended up being a profitable trade. And again, that's because you own this call option right here. And it completely changes the risk and reward dynamic oftentimes when a trade might be coming under pressure. So you can sometimes get out of a trade with a winner compared to a condor that might have been a loser, or you can even get out of a trade earlier, and I think I have an example. So here's an end of month October dragonfly compared to a condor. So let's look at these two here. So you can see here, this dragonfly closed out with a profit with 15 days till expiration. See the blue RTI on October 17. And let's make sure we're doing apples to apples. Same expiration, end of month October. Let's take a look at the condor and see how that did. So you had to stay in this trade with 9 days till expiration. So you were able to close out this position here on the dragonfly on October 17, but with the condor, you had to wait till October 23rd. So that's another advantage. Sometimes you get a chance to get out of that trade earlier compared to a condor when you're using a dragonfly. Also point out, let me go back here. Again, we're not just doing only neutral or non-directional strategies. With ThetaTrader, you have access to bearish strategies or bullish strategies. Something that we came up with a few years ago, just really a combination option spread. We call it a bull hedge, and you could do the same thing with a bear hedge, but you can also, of course, do typical put spreads, call spreads. You can do butterflies. But a bull hedge is essentially buying an out-of-the-money call spread, but to pay for it, you sell an out-of-the-money put spread. So here's what it looks like. So you buy this out-of-the-money call spread, but to pay for it, you sell an out-of-the-money put spread here. And we'll go ahead and see about just jumping in here with 3 of these. Sometimes you can do these for even money, so it doesn't cost you anything. But that's an example of how that might work. And I think this simulator here is showing you an example of a bull hedge. So again, to describe this trade, this here is a call spread that you bought. So the blue lines means you bought that call, and the red line you sold that call. But to pay for that, you sold this out of the money put spread. And typically it doesn't cost you much on a net basis, or it can be even a credit or even money. So just let that one play through, and you can see here, we're still not let's see, that's October 11. That's right. So you can see here that particular trade at that point was working out well, but this benefits if the market moves higher quickly enough. If it goes sideways, then you end up, both of these spreads, will end up basically going to zero. But just want to point out that ThetaTrader is very flexible, and it's not just non-directional in nature. And it's not only doing the E-mini S&P 500. For the most part, or I should say not S&P 500, but E-mini family of indexes. We do focus on the E-mini family because that's where all the volume and liquidity is. You can see the E-mini S&P 500, NASDAQ 100, and the Russell 2000. But we do like to pay attention to gold as well. And we do have some gold strategies available. You can do some call spreads in gold right here. And here's an example of a February gold spread, buying the 27.85 call and selling the 28.35 call as well. And having the gold here is really more of a side note, but the key core competency of ThetaTrader is really in those E-mini stock indexes. But here's what that gold looks like. You see, we made that run up to almost 2,900 and pulled back, and now we're starting to move up again. But that's what it looks like, and we'll go ahead and just place an order. We'll do, how about 4 of those? And there you have it. So that's what that looks like. And I'll also point out that we do have research up here. We have something called TradeScope we do every day with a little bit of technical analysis. And I know the presenter, Tim, before me did a lot of candlestick work. We use candlesticks as well. But this provides a technical review and also kind of an outlook as to what might be ahead. And then we also have something here called the daily trading comments, and you get current quotes from that day, and then you have a summary of what happened in Asia and in Europe and here in the US, and then looking ahead as to what to expect with any key economic reports as well. And that's all here on this one page. So people really like using this because it's short and sweet. You don't have to spend hours going through a bunch of research, I should say. So this is really useful for clients, only available to clients, and then this one here as well. And then also, this is important here, folks. Go to your settings and you'll see this page. And this is how you activate your risk manager by checking this box here. And then I'll point out that this is the automation. So whenever you hit a red RTI, too much risk in the trade, the order will be processed for you. But you can change this too. If you want a different risk level, maybe you want to use an orange RTI or a custom level. So you can customize it anywhere from 50 down to 25. But keep in mind, if you go low, say down to 25 on that risk level, then you will have more frequent losses, but the losses will be smaller in magnitude. So that's the trade-off. So we'll go ahead and leave that at the default. And then this is how you activate the profit directive as well. So to automate that, you check that box and then you'll have to save your settings. So this is an important page for you if you want your risk management and profit management to be automated and have ThetaTrader handle that order placement for you. So it's scanning your account every day and placing those orders for you when necessary. And then also there's a great help file here, and there's a great glossary. So if you want details on, I know I'm going quickly, but we don't have to get into all this, all the color coding and what that means, and all the definitions for all the spreads, that's all here. And there's also videos here. These are all like 2-3 minute short videos on how to navigate ThetaTrader, how to place the trades, and then here's some educational videos as well. So this is a great resource. It's all embedded here within ThetaTrader. Everything you need is part of ThetaTrader. And we talked about the trade alert. Let me show you how that works. You'll receive a trade alert sometimes, and it'll come on your dashboard, but also on your smart device and your email. It comes as a text message. And this is what it would look like. We'll go ahead and click this one here. Oh, excuse me, view. And this will take you to a page with a graph. So gives you, this is a December into month Russell 2000 Dragonfly spread, and it has 41 days till expiration. And you can see the structure of the trade. Here are the calls, here are the puts, here's the current market price right here. And then if you scroll down, you can see it's selling a quantity of 10 at an entry price of 740. You're trying to collect $2,860 of premium in your cash required here. And you can change the quantity, but only lower. You can't actually increase the quantity. You can't add risk, but you can certainly scale down if you'd like. But we'll go ahead and do 9 of these just to be different. And then you just accept. You touch accept, and that's it. So that's how easy it is to accept a trade alert if you're in your dashboard. And of course, if you're not in your dashboard, I'll show you how much better it might be just to receive it on your phone or email. But that's a real, if this were not just a demo account, that's exactly what it would look like here. And this is one for gold. And it's going to be the same process. People like having that chart to look at as well. And just that brief description, everything here, nice and compact, everything you need to know about the trade. So this is the spread that you're buying, buy the call, sell the call, and you're going to pay $4,116. It's a debit spread, quantity of 4, and then you just either accept it or reject it. So one or the other. If you don't reject it or accept it, it just expires at the end of the day. All right, folks. So there is a review of ThetaTrader in the demo. And one last part I wanted to show you. Maybe I'll go right back here. If you want to look at your open positions, you can see them all right here on your dashboard on the home page. See, these are all green, so do nothing. You can see your open bot positions here. Some are orange, some are yellow, but still do nothing. But it does make sense that some of these are orange because anytime you buy premium, that's a lower probability outcome. And those aren't going to really work as often. But here's how you look at your closed positions. And this might demonstrate what I just said a little bit better. You can filter for, the market or the month or the date range, but let's just go ahead and keep this simple and look at whatever's on this page here, 20 on each page. So you can see there's 20 trades on the page, 15 winners, 5 losers, and there were 15 short positions and 13 winners and 2 losers. So that makes a lot of sense because again, if you're selling premium that's deep out of the money, probability suggests that in the long run, you're going to have many more winners than losers. And then your bot positions, there's 5 here, but there were only 2 winners and 3 losers. And that also sort of makes sense. But you can see there's probably a big winner in there. I think that was a gold. Yeah. So you can see the big winner here was a gold call spread right here. But you can see all of the trades here on your closed positions. And this is just a demo account. Don't make much of the results because it's really random. Whenever I do some webinars every week or so, I just randomly place trades like you saw. But if you wanted to look at any one trade and see what happened on the history of it, you just click on it. So you can see I just clicked on this dragonfly here and we'll just scroll down. You can see the history of that trade. This is what it happened as you place that dragonfly. And you can see here, you placed it on September 13. And the P&L was negative for quite a while. And then as time went by and theta decay worked, it became profitable. And then here with 9 days till expiration, you had a blue profit taking signal. So that's what that looks like, folks. When you look at ThetaTrader on the dashboard, and let me show you probably what might be the best feature of all. It's really more of the trade alert that I just showed you. Okay, I'm going to go back to the presentation. So this is what it looks like on your smart device. So you'll receive a text message. These are one-touch responsive alerts like we just saw, accept or reject. And again, these alerts are live, meaning they're integrated with your trading account at AltaVest. So to accept the alert, you just touch accept. Here's what it looks like. You get a SMS, a text. You'll just have a link that you touch. It'll pull you right to the page. It'll give you a graph and a description of that alert and that trade. All the details. This is, of course, a few years ago, but it looks pretty much the same. There's a few additional features on the alerts like I showed you with the quantity that you can change. But you can see it's pre-selected with the quantity. Every alert that you receive is custom for you and your account. So it's pre-sized. Tells you how much premium you're collecting, what your cash required is. And this is all net, by the way. This is all net of any of your commissions, trading fees. So everything is net in ThetaTrader. 71 days till expiration, your targeted annualized return. So you either touch accept or reject. And that's it. It just works that simply. And there you have the demonstration of the software. So we're going to jump into how to become a member, how to get involved. We'll get into some FAQs and then talk a little bit about gold in the remaining 20 minutes or so here. I think I've got about. So the ThetaTrader software is everything that you saw. It includes theta trades, the risk thermal indicator, that's the color coding with the automation, the risk and profit controls, and then the trade simulator. You saw what a great tool that is. And then you have those one-touch trade alerts. Again, these are integrated with your account, very unique. I've never seen anything like this elsewhere. So you don't have to log in to a third party, a separate account, and try to copy an alert that you might receive from a newsletter service or something like that. So every trade you receive is unique for you and your account in terms of the quantity, and also to make sure it's not redundant with any other position in your account. So yearly value on that alert service over $4,400. So again, your ThetaTrader membership includes everything that we just saw. ThetaTrader, the alerts, valued at over $8,000. But I think what really brings it home is you get to work with us. You have coaches, mentors, people that are licensed and experienced that have been trading this and have traded millions of options. You have a co-pilot to work with you, discuss your strategy, your history. Probably invaluable. $7,500 value there for your coaching. Some people are paying $25,000 I've heard for investment coaches. But with ThetaTrader, that's all part of your membership, valued at over $15,500. And this is a little bit corny with this bonus, but I just don't want you to forget, you do get that proprietary research that's only available for ThetaTrader members, so TradeScope and the daily commentary, and then those online video tutorials, that is all part of ThetaTrader as well. That's all embedded in the technology. So just to summarize, your membership includes everything we just talked about, valued at over $18,500. But of course, that's not what we offer ThetaTrader for. We used to offer it for $4,000 in-person presentations. You have people at the desk signing up in the back and that type of thing. And that was all great. But of course, we do this online now. So for the first 12 that sign up, and yes, we do take a bit at a time because we're real people and we do onboard you, and you do get coached as much as you want. You do get a mentor, so it does take time. This is our lowest priced ever for timing research. It's only $497. So here's just a simple one form. You just put in your information and click to get your membership, and we'll onboard you. So that's the link, cf.altivest.com/TR. And that's a one-time payment. That's only one time. It's not every year. That's my direct phone number, my direct email. If you need me for any reason. But really, there's no excuse. You have a 30-day money-back guarantee on that. So if you sign up, decide it's not for you, that's fine. We'll refund that. No questions, no trouble. That's not our business. We're we're not here to twist your arm. So if you want a free membership, $100,000 account or more, you'll get a 100% rebate on your membership. So you get a full refund. If you have $50,000 up to $99,999, you get a 50% rebate. So people like to take us up on that offer. And for a few FAQs here, tax efficiency, people ask about that. Yes, futures and options are tax efficient. They're Section 1256 contracts, according to the IRS. And so what that means is, compared to trading individual stocks, you have a tax benefit here because your, capital, 60% of the gains essentially are taxed at your lower capital gains tax rate. So I don't need to go into that full example, but if you did the type of trading we're talking about with individual stocks and tried to do these condors and things like that, you definitely have a much more favorable tax setup here in this environment with the futures and option space. And there's no more itemizing each trade. You just get a 1099. I thought this was a funny picture here in the comment. It says his accountant is going through all the trades, reporting his 37-cent profit. So anyway, but do consult your tax attorney or advisor. IRA, yes, there may be some financial or experience requirements, so contact us, but we have IRA business as well. And again, we talked about the E-minis. Why the E-minis? Well, they're liquid, they're efficient, they're cost effective, a large market share. So you have strike prices and annual expirations, so you get the granularity and the coverage that you need for the algorithm to really find those trades. And that liquidity means you get superior execution according to the CME group, a cost savings of $4 to $15 per contract, trading on the E-minis, in particular the S&P 500. So you have a tight bid offer spread is what they're talking about. So again, we talked about that liquidity. So here's an example of our algorithm. If it needs a call strike and a put strike and another call strike and another put strike and so on and so forth, then you have that liquidity on the E-minis where you don't always have it in other markets. And another big benefit of ThetaTrader and doing the dragonflies, it's placed as one order at one trade at one price. So you don't leg in with a dragonfly. If you try to do a dragonfly in securities with stocks, you have to break up that spread into two different orders. So you have to leg in and leg out. It's actually quite miserable. So you don't want to try to do dragonflies. I wouldn't recommend it in any other market other than E-minis. And of course, using ThetaTrader we think is the best bet because you can do it as one order at one price. So these are sophisticated options strategies. Typical retail stock options traders only have access to the most basic call and put options. But they don't have access to option spreads or other more sophisticated strategies. So that's what we're talking about here. Remember, don't only buy options because theta is working against you. That's that woman here. I took her from this particular presentation on YouTube. I thought it was pretty good. But she says here, the appeal for retail investors to only buy options that they're much cheaper, but potential for profit is not that high. 2021, 11% of Robinhood active users made options trades, but fewer than 1% actually made multi-leg options trades. So more advantages with E-minis. Again, we're just tracking a couple different markets, not several hundred. Efficient margin, clear cost structure. There's no hidden fees. Every order is traded equally at the CME Group, electronic exchange, the Globex exchange. So there's none of that payment for order flow or no one's selling your order or anything like that. Commissions are 5.25 round turn, all in. So if you see other rates, be careful because sometimes it looks cheaper, but it's not because it's only per side. So you pay that much when you get in and then that much when you get out, then it ends up being more than what we charge. So our rates are competitive. And again, our rates, I'm sorry, the ThetaTrader data is net of all trading costs, and everyone performs differently because everyone trades differently. In terms of a minimum account size, the bare minimum is 10,000, but we do suggest 50,000. Different types of trading accounts, just like you would at any other brokerage firm. And just for the last few minutes here, I'm going to wrap it up with a brief chat on gold. I thought it was just interesting. It kind of reflects what's going on in the overall economy and economics anyway. But here's Alan Greenspan. If gold is a relic of history, why do central banks plus the IMF still hold 1 trillion of gold? If it's meaningless, why is everybody still holding it? So how about some relative performance? So this gold line here is the price of gold. You see the blue line is the S&P and the orange line is the Russell. So that's from October of 2004. So you can see that it's actually outperformed. So quietly been outperforming some of these major asset classes, and it's on track for its best annual return in 45 years, up 33%. And you have gold ETF demand. U.S. budget deficits are enormous. Inflation is a problem. Foreign central banks are buying. The BRICS are trying to work their way out of a dollar centric economy or petrodollar. Gold investor demand has come from Asia, not the West. So this is interesting. Here is ETF gold holdings, this black line, been dropping, but gold prices are soaring. So basically what's happening is all the central banks are the ones buying the gold lately. So just hit an all-time high. Who's buying? Everyday Americans are not buying yet. Federal spending, as we know, deficit spending is near record. We're at World War II levels now. And record high debt, 36 trillion. And that creates inflation. That's really the point of all this. The dollar value has dropped almost 99% since 1970, and gold just keeps moving higher and higher quietly sometimes. You can see it in our day-to-day routine. I thought this was kind of crazy how much fast food has gone up. But here's the value of the dollar, down 99% since 1971, and meanwhile look at gold. It's up from $35 up to 2,900. I think 78 times. And if you want to look at inflation, here's the government data here, this red line. And here's the price of gold. And a lot of calculations suggest the real rate of inflation is this blue line, calling the shadow stats. Here's Paul Tudor Jones says all roads lead to inflation, and that's why he's long gold. Here's an article, why gold is looking better than stocks. Gold is a useful diversifier. It's a hedge against unexpected inflation. October CPI showing signs that disinflation trend is fading. So this is interesting. You look at a chart, this red line here is the CPI from 1970 to 1979, and it's overlaid with the blue line, which is the CPI from 2017 to 2024. So I don't know if we're going to follow this, but it looks like the disinflation we've experienced is kind of coming to an end for sure. Foreign central banks continue to buy gold. Here's Altivest here and Market Watch talking about an important level at 2,500. Foreign central bank gold demand remains most important bullish driver for gold, and gold may not reach a price ceiling anytime soon. Out of control federal spending, debasing the US dollar, and foreign demand remain strong. So that's from our business partner here, Mike, co-founder of Altivest. So central banks have never bought so much gold. So I won't go on and on, but even Greenspan, remember, gold is a currency, and something we sometimes forget. In the BRICS countries, they're looking to establish a precious metals exchange, crypto exchange, establish a BRICS non-dollar payment system. So in summary, there's a lot behind gold, and we think it makes a lot of sense to kind of have a little bit of that in your, I guess your, what do they call it, quiver? And we like ThetaTrader a lot because it's a non-correlated asset and it can provide diversification. So just to kind of summarize some of the benefits of the E-mini stock index option strategies: any market condition, wide margin of error. You have the convenience of automation with ThetaTrader. You can diversify with these option strategies. You don't have to always be bullish on something. And then that one-touch responsive trade alerts. So no day trading. You don't have to worry about this. Thought that was a pretty good image. Wide margin of error on a lot of these types of non-directional trades. We talk about being a time saver. You really don't want to probably sit in front of the screen 10 to 12 hours a day like some of these day traders are doing. You can diversify. You don't have to just be passive and always buy something. Keep in mind too, diversification can hopefully limit drawdowns. Keep in mind drawdowns can sometimes last decades in a stock market. If you are unfortunate enough to buy at the wrong time, what if you bought in, I don't know, January of 2000? I don't think you recovered if you did nothing till something like 2013 or 14, if I can recall. But again, those one-touch trade alerts, you saw how those work, and they also come to you via email or on your dashboard. That's how they look on your page, your text message, and you just touch accept. And remember, Wall Street uses those option spreads, buying and selling of different contracts, common way for investors to hedge risk and volatility, and it's usually cheaper. You can offset your cost by the proceeds from different contracts. So she's absolutely right, and it's been used by Wall Street professionals for decades. So that's what we're doing. We're trading professional style option strategies with ThetaTrader. So feel free to get yourself signed up, become a member. We'd love to have you. This is what will happen once you sign up. You'll just get onboarded. You'll get your credentials to log in and begin talking to us, and we'll get you started with those algo-driven options trades, hopefully help you control your emotions with some of the automation. And again, these are strategies for any market condition. You'll have fun using that trade simulator as well. Kind of call it that time machine. So there you have it, folks. That's the end of my presentation. Let's see if I have a moment. There's a few questions in here. Thanks for the questions. Keep them coming. Why a dragonfly over a condor? I think I explained that. Option spreads always less risky than naked options. Well, I don't know if I want to use the word always. It depends on the trade. But if you're trading a covered spread versus a naked option, then yes, your risk is predetermined. compared to a naked option. The commissions are 5.25 per option. That's right. Emotion-free trading. I wouldn't say it's emotion-free, but it's better than biting your fingernails and screen watching for 3 or 4 hours in the day. But I think that's why people really like using ThetaTrader. Yep, gold wants to remain obscure. That's right. It's been quietly sneaky for sure. But if there's any other questions, let me know. And I think I'll wrap it up unless there's anything else. But thanks for joining me, and give me a call. You see, you can take a screenshot here of this last slide if you'd like. You can call me. That's my direct number, my direct email. We're real people, and we'll be glad to help you out. And do take advantage. That offer does expire, and it is limited for the first 12 people because we do have to spend time with you and get you onboarded. So thanks again.